Welcome to the Deep Dive. Today, we're going deep on Realty Income Corp, or O, as you'll see it on the ticker. They're a REIT, a real estate investment trust, and we're going to figure out if they're a good investment for you.
Sounds good.
We've got a whole stack of Morningstar reports to help us out here. We've got analyst notes, look at their business strategy, and even what the bulls and the bears are saying about their future.
It's December 2024. And it's an interesting time to be looking at REITs. Like Realty Income, we've had some volatility with interest rates this year. They've fallen since July. And that's going to have some implications for REIT valuations.
Definitely.
For sure.
And Realty Income right now, it's trading at $56.17 cent share, which is actually below Morningstar's fair value estimate of $75. So maybe there's an opportunity here.
Yeah, perhaps. But we need to dig a little deeper to really see if it makes sense for you. One of the things that Kevin Brown, he's a senior equity analyst over at Morningstar, points out in his notes is that public REIT valuations, they've actually dropped more than private real estate valuations since the beginning of 2022. So he thinks this could be a buying signal, especially as interest rates start to stabilize.
That makes a lot of sense. A lot of investors get spooked when interest rates go up because REITs often use debt to finance their acquisitions.
Exactly.
And Brown specifically calls out concerns about Realty Income's growth prospects. He thinks that those rising interest rates are going to impact their ability to fund external growth through acquisitions, leaving them with a potentially less exciting story of slow internal growth.
Yeah. And so let's unpack Realty Income's business strategy a bit. So they focus on owning and managing those freestanding single-tenant properties you see everywhere, primarily in retail. So think your local CVS or Walgreens, that kind of sense.
Those are everywhere.
They're also well known for their monthly dividend company approach, which definitely appeals to investors seeking a steady stream of income.
Absolutely.
That stability comes from their preference for long-term triple net leases, often spanning 15 years or more. And with these leases, tenants handle most of the costs, operating expenses, taxes, even maintenance. It creates a really predictable income stream for Realty Income. But there's a trade-off.
Okay. I was sensing a but coming.
To maintain that stability, Realty Income typically has very low annual rent increases built into those leases. We're talking around 1%. And that limits their internal growth potential, meaning they rely very heavily on acquisitions to fuel that expansion.
And in a world where interest rates have been volatile, those acquisitions become more and more challenging to finance. And that's a key takeaway for our listeners out there, understanding how interest rates can impact a company's ability to grow. But let's play devil's advocate for a second. What's the bull case for Realty Income?
Yeah, so the optimists point to that reliable monthly dividend, which is a big draw for a lot of income-focused investors. They also like the company's financial flexibility and proven ability to make strategic acquisitions. And then there's a lot of confidence in the management team. They have a reputation for transparency and accountability.
So they're a well-managed company with a history of delivering consistent returns to shareholders. Sounds pretty good so far.
Yeah.
But what about the other side of the coin? What are the bears saying?
Right. Well, the bears worry about those long-term leases in the face of inflation, so those minimal rent increases might not keep pace with rising costs and potentially squeezing Realty Income's profits over time. And they also question whether the company can consistently find attractive acquisition targets, in a more competitive market, particularly with interest rates being less predictable these days.
Yeah, it seems like the big question swirling around Realty Income is their ability to grow in the future. But there's another important factor we need to consider here. Their so-called economic moat. This is something that Morningstar analysts look at very, very closely. Do they have a durable competitive advantage that can protect their profits over the long haul?
This is where things get a little less rosy for Realty Income. Morningstar's assessment is that they lack a significant moat.
Really? Why wouldn't a company with their size and experience have a moat?
Their reliance on acquisitions for growth is one factor, but it also comes down to the nature of their properties. They tend to be fairly generic, essentially blank slates for tenants. This means there are few barriers to entry for competitors. Other developers can easily create similar properties.
So while Realty Income may be a dependable dividend payer with a solid track record, their lack of a moat means they're not immune to those competitive pressures. Let's move on to their fair value and the key drivers of their profits. Morningstar has assigned a $75 per share fair value estimate for Realty Income. What's the logic behind that number?
Their valuation is based on a 5.8% cap rate, applied to their projected future net operating income. This means they're accounting for Realty Income's relatively low internal growth rate, which averages around 1.5% annually, primarily due to those minimal rent escalations we talked about earlier.
So to reach that $75 fair value estimate, they're assuming Realty Income will be able to continue finding and executing those profitable acquisitions.
Exactly.
And their future growth hinges on their ability to keep sourcing deals. That makes sense in a changing market.
Right.
And that's not a guarantee.
Not at all.
Now let's shift gears a little bit and delve into some of the risks and uncertainties surrounding Realty Income. One thing that stands out in these reports is that a significant portion of their tenants are not investment grade. Plus, a large chunk of their income is concentrated in their top 20 tenants. What happens if some of those tenants hit a rough patch?
Yeah, that's a valid concern. However, Morningstar points out that their high EBITDA coverage ratio provides a buffer.
Now, for our listeners who may not be familiar with that term,
Yeah.
can you break down what EBITDA coverage ratio means?
Sure, it's a financial metric that measures a tenant's ability to cover their rent obligations. Essentially, it looks at their earnings before interest, taxes, depreciation, amortization, and rent expenses. A higher ratio means the tenant is in a better position to make their rent payments, even if their business faces some challenges.
So it's a way to assess the financial health of Realty Income's tenants. A high ratio suggests they're less likely to default on those leases, even in a less than ideal economic environment.
Are there any other risks investors should be aware of?
Well, one risk is that the competition for those lucrative acquisitions could heat up, driving up prices and potentially squeezing Realty Income's profit margins. So it's a balancing act, finding those deals that generate attractive returns without overpaying. Speaking of making smart decisions with capital, Realty Income has received an exemplary capital allocation rating from Morningstar. That's got to be a good sign, right?
Absolutely. It highlights their history of prudent financial management, disciplined investment decisions, and a capital return strategy that's focused on balancing shareholder payouts with long-term growth.
Let's dig deeper into that capital allocation strategy in the next part of our deep dive.
That exemplary rating for capital allocation you mentioned speaks volumes about Realty Income's management team and their commitment to creating shareholder value. It's not just about finding good deals, it's about ensuring those deals make financial sense and contribute to the company's long-term success.
So they've got a good track record of deploying capital wisely. But how does that translate into actual results for investors? What can you tell us about their recent earnings performance?
Well, their third quarter report offers some interesting insights. There were a few mixed signals. Occupancy dipped slightly, but both occupied square footage and economic occupancy edged upward.
Economic occupancy, that's one we haven't touched on yet. Can you explain what that means for our listeners?
Yeah, so it's a way to gauge the true revenue-generating potential of a property. So imagine you have a building with 10 units, but only 8 are currently leased. Your physical occupancy is 80%. But maybe those 8 tenants are only paying 90% of the total potential rent due to discounts or concessions. So your economic occupancy would then be around 72%. It gives you a clearer picture of how effectively the space is being monetized.
Oh, that makes sense. So in Realty Income's case, even though occupancy dipped a bit, the fact that economic occupancy increased suggests they're doing a good job of maximizing the revenue from their properties. What about those all-important rent increases? Were they able to secure any decent releasing spreads on new leases?
They did. Releasing spreads came in at a solid 5%, which is encouraging.
Now, to break that down for our listeners, a releasing spread is the difference between the rent on a new lease compared to the rent on the expiring lease for the same space. So a 5% spread means they're getting slightly higher rents from new tenants, which helps offset some of those inflationary pressures we discussed earlier. But what about the big picture? How did same-store net operating income, or NOI, essentially the profitability of their existing properties, fare in the third quarter?
Yeah, that's where the growth story loses a bit of its shine. Same-store NOI only inched up by a mere 0.2% year over year. Not exactly a number that's going to excite growth-focused investors.
Yeah, that's pretty sluggish growth. Anything in particular dragging them down?
A couple of things stand out. Rent from theater tenants took a significant hit, dropping by over 18%. And convenience stores, which represent a decent chunk of their rental income, also saw a decline.
Theaters struggling. That's understandable given the changes in the entertainment landscape. But convenience stores, those are supposed to be pretty resilient, aren't they?
You'd think so. They're often seen as recession-proof, but even they're feeling the effects of the current economic climate.
So with these headwinds, what did their overall profitability look like for the quarter?
Despite the challenges, they still managed to deliver a respectable adjusted funds from operations, or FFO, of $1.05 per share.
Now, FFO is a key metric for evaluating REITs like Realty Income. It's essentially a REIT's version of earnings per share, providing a more accurate picture of their cash flow and ability to pay dividends. So $1.56 per share, how's that compare to previous quarters?
It's a decent result. It represents a 3.3% increase compared to the third quarter of last year, so they're at least moving in the right direction.
Okay, let's not forget that acquisitions are a major part of Realty Income's growth strategy. Did they make any notable purchases during the quarter?
They were quite active. They invested almost $600 million in property acquisitions during the third quarter alone, and they've got another $146 million worth of properties in their development pipeline.
Wow, that's a significant amount of capital being deployed. Are they sticking to their traditional focus on freestanding retail? Or are they branching out into other types of properties?
They're definitely diversifying their portfolio. The recent acquisitions include everything from industrial properties to gaming, even some office assets.
That's an interesting shift. It seems like they're recognizing the evolving landscape of the retail sector and looking for opportunities in areas with potentially stronger growth prospects. But with diversification comes new risks. What can you tell us about the cap rates on these acquisitions? Are they getting good deals? Or are they overpaying to chase growth?
The cap rate on their third quarter acquisitions came in at 7.4%, which is generally considered a healthy number in the current market.
Now, for our listeners who might not be real estate experts, can you quickly recap what cap rate means and why it's important?
Sure, think of it as a measure of the potential rate of return on a real estate investment. A higher cap rate generally suggests a better deal for the buyer. In Realty Income's case, a 7.4% cap rate is significantly higher than their current cost of capital, indicating they're buying properties at a discount and creating value for their shareholders.
So they're not just buying any property they can get their hands on. They're being selective and focusing on deals that make financial sense. But those acquisitions require funding. How are they financing these purchases?
They're using a variety of funding sources, including issuing over $270 million worth of common stock, a $500 million unsecured note, and even some bonds denominated in British pounds.
Bonds in British pounds. That's a new one. It seems like they're pulling out all the stops to fund their growth ambitions. But we can't ignore the elephant in the room. Interest rates. We've talked about their impact on REIT valuations and acquisition costs, but how are these rising rates specifically affecting Realty Income's ability to generate those attractive returns investors have come to expect?
It's a complex issue. On one hand, rising interest rates make it more expensive for Realty Income to borrow money, which increases their cost of capital and can eat into their profit margins on those acquisitions.
So it's a squeeze on their profitability. But I imagine there's another side to this coin, right?
Exactly. While higher interest rates increase their borrowing costs, they can also push up cap rates, potentially creating opportunities to buy properties at more attractive prices.
So it's a balancing act. They need to be strategic and find those sweet spots where the cap rates are high enough to offset their increased financing costs.
Precisely. It's a challenging environment for REITs, and Realty Income is no exception. They need to be nimble and make smart decisions to navigate these headwinds successfully.
Speaking of navigating challenges, Realty Income has a long history of steady dividend payouts. It's one of their key selling points. But can they keep up this pace, given the pressures they're facing?
That's a question a lot of investors are asking. They've been diligently increasing their dividend for years, even during economic downturns, but with interest rates on the rise and competition for acquisitions heating up. Some analysts are wondering if they can maintain this impressive streak.
No one wants to see their dividend checks shrink, so it's a valid concern. But is there anything in their financials or their strategy that suggests they might be able to weather this storm?
Well, one positive sign is their relatively conservative dividend payout ratio. They're not paying out all their earnings in dividends, which gives them some flexibility to maintain those payments, even if their growth slows down a bit.
So while there's no guarantee, their history of prudent financial management does offer some reassurance. To income-focused investors, they've weathered many storms before, and they've consistently prioritized rewarding their shareholders.
Yeah, that track record of resilience is definitely something to consider.
We've covered a lot of ground here, from their business strategy and earnings performance to the risks and uncertainties they face. But I think it's important to bring it back to our listener. What does all of this mean for someone considering investing in Realty Income?
That's the million-dollar question, isn't it? We've seen that Realty Income has a lot of positive attributes: a solid dividend history, a diversified portfolio, and a management team that's well regarded for its capital allocation skills.
But they're also facing some headwinds, those concerns about external growth, the lack of a significant economic moat, and the potential impact of rising interest rates are all factors that potential investors need to weigh very carefully.
Yeah, it ultimately comes down to your individual investment goals and your tolerance for risk. Are you comfortable with a company that relies heavily on acquisitions for growth in an environment where those acquisitions might become more challenging?
That's the key question for our listeners to ponder. We've given you the information and the insights. Now it's up to you to decide whether Realty Income is the right fit for your portfolio. We've covered a lot of ground in our deep dive into Realty Income. We've looked at their business model, their financials, the risks they face, and their potential for future growth.
It really comes down to this. Is Realty Income a company that can adapt and thrive in a changing environment?
That's the question, isn't it? We've seen that they're taking steps to diversify their portfolio beyond traditional retail, and they've got a history of prudent financial management. But those low internal growth rates and their reliance on acquisitions for expansion makes their future a bit uncertain.
Especially given that potential for increased competition for those acquisitions and the impact of rising interest rates.
So what's the takeaway for our listeners? What should they be thinking about as they consider whether Realty Income is the right investment for them?
I think it's crucial to connect Realty Income's story to your own investment goals and your risk tolerance. If you're looking for a company with a high growth profile and a wide economic moat, Realty Income might not be the ideal fit. But if you're seeking a dependable dividend payer, with a history of navigating market cycles and delivering consistent returns, Realty Income might be worth a closer look.
It's not about whether Realty Income is a good or bad company in isolation. It's about whether their strengths and weaknesses align with your own investment objectives.
Exactly. You need to ask yourself, do you believe in their ability to continue finding those value-creating acquisitions in the years to come? Do you think their management team can adapt their strategy to overcome the challenges of a changing retail landscape and rising interest rates?
Those are the big questions, and the answers will depend on your own assessment of the company, the market, and your personal financial goals.
We've given you the framework and the insights to start forming your own educated opinion. Now it's time to do your own due diligence. Weigh the risks and rewards, and decide whether Realty Income deserves a place in your portfolio.
And don't forget, the investment landscape is always changing. Keep an eye on those interest rates, monitor Realty Income's earnings reports, and acquisition activity, and stay informed about the broader economic trends that could impact their performance.
Knowledge is power when it comes to investing. The more you understand about a company, the market, and your own investment objectives, the better equipped you'll be to make smart decisions.
That's the heart of what we do here at Podcast Finance Daily. We want to give you the tools and insights you need to become a more confident and successful investor.
So keep learning, keep exploring, and never stop asking questions.
And if you have any questions about Realty Income, REITs in general, or anything else related to investing, leave us a comment below. We love hearing from our listeners.
We're all on this investing journey together.
Before we sign off, don't forget to like, share, and subscribe to Podcast Finance Daily so you never miss an episode. And until next time, happy investing.